Today's presentation is on what we believe is the best space stock out there right now. Now, the first thing we need to do is start by quantifying the word best. One man's trash is another man's treasure. So what we see as best would be a company that can, first of all, survive. That's the ultimate goal of every firm. So when we look at survivability, things like gross margins and runway are metrics that we use to evaluate that. When it comes to business models, software as a service is highly desirable. It's ascribed a premium by the market. That's because it's predictable. It scales, and as it scales, gross margins expand, and you can use consistent SaaS metrics to evaluate companies across different industries. Now, space is a particularly risky theme, so we want to minimize our risk as much as possible. Now, when we look at our own 38 tech stock portfolio, here are the category weightings. You can see we're overweight life sciences, AI, IoT, and we're quite underweight space and cannabis. That's because these two themes are particularly risky, but they also happen to be the most popular amongst retail investors. So we certainly want to have some skin in the game. Now, we recently did a presentation on top space stocks and pointed to two space stocks that we really like, Rocket Lab and Planet Labs. Well, actually, Planet Labs we love, which means we're holding the stock right now. And the question is, do we want to add more shares of Planet Labs? Now, the reason that we really love this firm is because they're a software as a service business model. They're expanding their margins over time. They have a nice cash runway, and they may be immune to Starlink, meaning that Starlink may not get into geospatial intelligence, which is what Planet Labs does. And of course, in our presentation on top space stocks, we talked about why we also like Rocket Lab a lot, but we're waiting to see if they can make reusability work. Now, somebody had recently asked us how low we thought the market could go, and we sort of danced around that question, but we'll postulate an answer here, which is that you can see here this chart of the market sliding throughout 2022. It's just off all-time lows, and there's no reason to think that it won't continue sliding in 2023. Now, when you try to think about how low it can go or how long it could last, one thing you look at is, well, what were previous lows looking like? And in the pandemic panic of March 2020, we saw the market fall to a level where it was 35% below today's levels. No reason to think it couldn't test that. Trillions of dollars of value evaporated because of the pandemic in travel and in other areas. So certainly we could think it would touch on those levels. And if that happens, stocks across the board could sink even further. A falling tide lowers all ships. So when the bear market started this year, our rule was that positions that we were in prior to the bear market coming around, we wouldn't add to those positions unless they fell 50% or more below our cost basis. And that would put Planet Labs at a price of $3.45. Now, we don't like to use price targets, but for this particular rule, it works. The 52-week low is $3.70. So the market continues going lower. It's likely that shares of Planet Labs will go lower as well. Now, let's talk a little bit about their recent earnings call. And one thing that we noted is that the management at Planet Labs seems very competent. First of all, they're transparent about their problems. And that's important for a management team because everybody that works for you internally is aware of what the problems are. And then when you tell a different story to the market, that shows that you're somebody that doesn't tell the truth. And being transparent just works best most of the time. A legal team might disagree with that, but generally speaking, it's good to be transparent. When you're transparent and there's a problem, you tell the market about it. You should establish key metrics to monitor that problem. And whatever you do, don't break promises. We're very particular about that. In the SPAC era, a lot of companies broke their promises. If you do, address it. An example of that would be Proto Labs, which didn't address their $1 billion by 2025 goal that they sort of swept under the carpet. Now, one of the things we didn't care for at Planet Labs was this notion of win-backs, and they define that as a previously existing customer who was inactive but has reactivated. In other words, if you have a product that you need to go out and convince customers to use after they initially used it and they stopped using it, that doesn't bode very well for the stickiness of your platform. But props to the management team for seeing that problem, defining it, and creating this new metric to evaluate it. And it seems to be working well. So what we look at as a traditional retention metric would be this NRR, what they say is NDRR, net dollar retention rate, which simply shows the percentage of money that existing customers are paying in any given time frame. So if they're paying 123%, that means they're spending more money with you than they would be if their spend was flat, which would represent 100%. So net retention rate for Planet Labs is looking quite good. Now, this notion of customers not being happy with the platform or not spending more money on it can also be reflected in other ways. And I wanted to raise this notion of terrorists versus champions. If there's anybody out there that's in marketing, maybe you remember what this scale looked like. And it was a scale on the left-hand side, you had terrorists, and on the right-hand side, it was either prophets or champions. And I tried to Google the hell out of this and find it because it was very useful, but I couldn't. And let me give you an example. So when I travel, and I travel a lot, you see this bag here. This is from a company called 511, and I tell everybody that I interact with how great this bag is. I absolutely love it. It's a spectacular product. I talked about it so much, they actually sent me a free one. This is a great product. I'm out there championing this product. I'm not being compensated. I love it. Another example would be Interactive Brokers. Even though they screwed us out of thousands of dollars of affiliate fees that we should have received, and their customer service was horrible in addressing that problem, they've never rectified it, I still recommend that platform to people because none other can stack up to it. They let you trade on dozens of exchanges across this planet, and Interactive Brokers, we still use it to this day. So that's a product that's so good, people are out there championing it. Now, on the other hand, you have a product that sucks horribly, and every opportunity I get, I tell people, don't spend money on Facebook ads. You're pissing that money away. Probably the most rubbish product out there when it comes to advertising and marketing. So you can see there that ideally you want your customers to be out there for free telling people how great your product is. Well, there's a measure for that, and it's Net Promoter Score, NPS. And for each industry, there's a average Net Promoter Score, an average NPS. Here you can see for B2B companies what that looks like. Now, for Planet Labs, in their recent investor presentation, they pointed to the fact that they've raised their customer satisfaction score significantly from Q2 2022 to Q2 2023. Unfortunately, they use fiscal years, and it's horribly confusing, but you get the picture. So they raised that quite high, and then they point to this score for their top 50 accounts, and what's most important, their key accounts above $1 million in annual contract value. That's similar to annual run rate, ARR, or ACV. So that's quite good. They identified the fact that customers were using the product and leaving, presumably because it sucked. Then they worked to fix that. They identified a metric. Then they looked at NPS. Very, very competent management team stepping in there and making sure that they corrected that problem. As a result, they're on target for fiscal 2023. Really happy to see this. So their SPAC deck, they told everybody in fiscal 2023, we're going to hit $191 million. Look how close they are to that. So this chart I put up mainly because I was too lazy to recreate this in Excel, but the numbers are slightly off. At the bottom here, you can see what they're estimating based on their last quarterly call, which is midpoint $190 million. That's $1 million off from what they said, what they promised in their glossy SPAC deck. That's awesome. Most SPACs never hit their target. So a couple other metrics to look at here that are in their investor deck that are very useful. First one on the left here is the number of customers using more than one product and how that increases over time. That's great. Similar to how CrowdStrike has a modular approach, or any of these large SaaS firms take a modular approach to how they're selling. I don't know what these look like for Planet, but how they've broken that out and how they're quantifying it is very useful. On the right here, you can see momentum in customers that are spending more than $1 million, key customers. Great to see. Another metric that looks quite good here when we start to evaluate survivability is the increasing gross margins over time. As of the last quarter, they have $425 million in cash. They're burning about $45 million per quarter, so they have roughly 2 years of runway. That's great to see. Now, when it comes to leadership, we've had some heated conversations with individuals about whether or not Planet is a leader or Maxar. Well, we're no longer going to be able to evaluate Maxar because they were acquired by Advent, or they will be anyways. And then there's also Airbus that does imaging, and we don't really have any insights into how competitive that solution is, but we can probably all agree that Planet and Maxar are leaders in geospatial intelligence. Now, when we look at our tech stock catalog, we have an Excel spreadsheet with lots of data fields that has 460 tech stocks that we cover. And in there, I simply filtered on geospatial intelligence. And here are the 4 firms that popped up. Planet, of course, that we've talked about, and these other 3. And because they're so small, they're under $1 billion market cap cutoff, we would never consider investing in these. But what you can do is pull up the research piece that accompanies this video. I'll put a link to that in the description, and you can see the research pieces that we wrote. And we talk a little bit more about them and provide a short update. We wouldn't touch any of those firms, and Planet clearly stands out. Now, just to conclude, space is an inherently risky theme. So Planet, when we look across the domain of space stocks, it's probably the best stock out there right now. Management team, very competent, at least what we've seen so far in terms of their ability to identify problems and fix them and to hit their goals. Growth is continuing as projected, but it's going to be very difficult. They're expecting, according to the glossy SPAC deck, 50% revenue growth for fiscal 2024. So we see that as a pivotal year. Again, the confusion here, not 2023. 2024 will be a pivotal year if they can hit that 50% growth in the face of macroeconomic headwinds. Now, if we choose to add shares, we'll send email alerts to our premium subscribers, our annual premium subscribers. And I've also put up another video here on top space stocks you might be interested in, but please first click the Nanalyze logo on the right, subscribe to our channel. Thanks so much for taking the time to watch this today.